Welcome back to my channel, where I unravel the mysteries of the financial world. In today's video, we'll get into the concept of stock dividends. Have you ever wondered what they are and how they work? Well, you're about to find out. Let's start with the basics. What is a stock dividend? A stock dividend is a payment to shareholders that consists of additional shares in a company rather than cash. This means that instead of receiving a monetary payout, shareholders receive additional shares based on their existing holdings. To better understand, let's consider an example. Imagine a company issues a stock dividend of 5%. If a shareholder owns 100 shares, they would receive an additional 5 shares. It's like getting a bonus in the form of more ownership in the company. Now, let's explore some key takeaways about stock dividends. First, stock dividends are not taxed until the shares are sold. This can provide a tax advantage to investors. Second, stock dividends dilute the share price because additional shares are issued, which can affect the per-share value. However, stock dividends do not impact the overall value or worth of the company itself. Lastly, companies may choose to pay dividends in stock to preserve their cash reserves and still reward shareholders. But how does a stock dividend actually work? Let's dive deeper. A stock dividend, also known as a scrip dividend, is typically paid out when a company wants to reward its shareholders but either lacks the available cash or prefers to preserve it for other purposes. By distributing additional shares, the company can reward shareholders without reducing its cash balance. However, it does increase the company's liabilities. Stock dividends have advantages and disadvantages for both investors and companies. From an investor's perspective, receiving stock dividends may not provide immediate monetary gain, but they offer the potential for future value appreciation. For companies, stock dividends are a way to issue dividends without depleting their cash reserves. One important aspect to consider is stock dilution. Stock dividends dilute a company's existing shares, as more shares are issued without a corresponding increase in capital. This means that the value of each share decreases, but the overall ownership remains the same. It's similar to a pizza being divided into smaller slices, even though the total size of the pizza remains constant. Let's take a look at the accounting aspect of stock dividends. When a stock dividend is issued, an accounting journal entry is required. This entry transfers the value of the issued stock from the retained earnings account to the paid-in capital account. The specific journal entry depends on whether the stock dividend is considered small or large. To put it all into perspective, here's an example of a stock dividend calculation. If a company declares a 10% stock dividend on its 500,000 shares of common stock with a par value of $1 per share and a market price of $5 per share, the value assigned to the dividend would be $250,000, considering the market price. It's important to note the distinction between small and large stock dividends when determining the accounting treatment. And there you have it, stock dividends explained. Remember, they offer a unique way for companies to reward shareholders and provide potential future value. If you found this video helpful, be sure to hit that like button and subscribe to my channel for more informative content.